Good afternoon, ladies and gentlemen. Welcome to the HEIQ Investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish those responses on the Investor Meet Company platform. Before we begin, we'd like to submit the following poll, and your participation will be warmly welcomed by the company. And I'd now like to hand over to the management team from HEIQ to take you through today's presentation. Good afternoon to you guys.
Thank you very much for the introduction and welcome to our shareholders. I'm happy to. Can you hear me?
Yes. Yes.
Okay, thank you.
Yes,
I just got a message that you can't hear me, but I'm ignoring that message. So, and welcome to the.
Carlo, we have just lost your audio, Carlo. If I could just ask you to, ladies and gentlemen, just bear with us while we just reconnect Carlo. Just do bear with us, ladies and gentlemen. We will just bring Carlo back in. Thank you. Carlo, if you just press allow there, I'll try and get your microphone back on. Carlo, can you hear me okay?
I can hear you okay.
Okay, I can hear you now, sir. So please do go ahead.
Okay, thank you. So apologies for the technical. So I'm going to walk you through the agenda. If I drop out, Xaver will take over. Looking back, 2022 first half year, measures taken, and then also what's the focus on the ventures and the outlook going forward. So let's look back quickly. What happened? We have been almost a year ago facing what is a demand cliff from brands, especially in the textile industry. This purchasing stop happened because there has been historically high overstocking by the brands, and there has been a strong decrease in consumer demand following high inflations and high interest rates. This has had serious effects. It has caused to impair, if you want, for some time our business model, which has been to generate profits with commercialized technologies, and with that profit finance innovations that we have been pushing. Now our innovations were advanced and were in very good value creation progress, which made it very difficult for us to stop them completely. So we needed to maintain them, but the source of cash that we were using to do that had gone away with what then later turned out to stabilize at a minus 40% of market demand that has persisted throughout the entire year that we have faced it now. It has also led us to reconsider our inventories. We have done a write-off of inventories based on a shorter term visibility that the market is giving us at the moment. In general, we had acquisitions that we did in 2021, and in general they were not able to materialize their business plans. They had a delay in achieving their business plans, and because of that we had to do an impairment of the goodwill and write off a large part of that. Now we still believe in these acquisitions, and we still believe that they will be value creating in the near future when the market's especially recovered, and we've done significant steps to create value with them over the past year in a difficult situation. Another challenge we had was switch and harmonization into one global CRM and ERP system for all our companies. This was more difficult and more delayed. So the auditor, which we onboarded late November 2022, was confronted with a difficult situation that the data that he had was out of several systems, and that led also to a later audit, 10 months audit that we did, which led to 6 months of suspension, for which we are very sorry, but which has now been addressed and in future won't happen again. Now I would like to jump quickly into the past numbers, and I hand over to Xaver.
Thank you, Carlo. If we look first into our sales and gross margin, we see sales clearly suffered in 2022 with 47 millions, which is clearly significantly below the prior year. As mentioned by Carlo about the market conditions that have weakened at the end of the year was one driver, and as we have also communicated in the market update yesterday, we could not, as previously and as expected, recognize revenue around development milestone contracts, as well as in relation to the contract with ICP, where we filed a claim for a year ago. So in discussions of the auditor, they had a different view on our prior auditor, and so we had, unfortunately, were not able to recognize these revenues as planned. The demand in 2023 continued to be weak, as also mentioned by Carlo, and with 20 million revenues in the first half of 2023, we see similar revenues as in the second half of 2022. Our gross margin for the year 2020 is with 28.5%, very low. However, it has to be considered that this is after a significant write-off on inventory. If that would be factored out, then we would also be in the 40s with our gross margin, and we are in 2023, as you can see in the first half year, at 41% again. If we look at the entire profit and loss statement, as clearly the top line sales and margin led to a significantly reduced contribution or gross profit, and you also see that our SG&A costs in 2022 increased by about 6 million compared to the prior year. This cost increase includes different drivers. One is that for the 2021 acquisitions, they are now included 12 months. We also invested significantly in our innovations, in particular in HEIQ Ionic, where we built up the pilot plant basically during 2022, which comes at the costs that are mainly captured in our SG&A, and last but not least, also the delay in the audit has significantly increased our audit costs, which are accrued for as of last year as well. If we look at the half year cost situation in 2023, you see that this is in line with the previous year. However, the various cost reduction measures we have implemented in course of the first half of this year have not yet materialized by June. Most measures we have taken are around personnel costs, which have a certain time lag until they become effective, and these will improve our cost position only in course of the second half of 2023. The impairment losses, mainly from goodwill, with over 12 million in 2022, of course, has also a significant impact on our profitability in last year, which results in a net loss after tax of almost 30 million. In the first half of this year, given the low revenue level and the cost structure that is not yet profiting from the restructuring, this has led to an operating loss of 6 million and the income or a loss after taxation of 6.5 million. If we look at our balance sheet, of course, the goodwill impairments, the allowance on inventories, they have significantly reduced our total assets. And as mentioned by Gallo, we have been using cash for our operations. So we have seen a cash burn situation, and as such, we had a cash position of 7.3 million as of June 2023. Accordingly, we had to increase usage of our credit facilities, which is reflected in the short-term borrowings line item, where you can see that we have 7.5 million of short-term borrowings, which includes or which reflects the usage of our uncommitted credit facilities of about 2/3. Since June, we have not increased the usage of the credits limits any further up to now. As mentioned, you see that cash flow-wise, we have suffered a significant cash use for operating activities. We have nevertheless continued to invest, and you see that financing or cash flow from financing activities is basically a reflection of the increase of our usage of credit facilities. On the right side, you see the situation as of October, as of today, which is basically the same as it was end of June, with 6.3 million out of 9 million credit facilities used. As mentioned before, our key focus since the beginning of the year is to avoid further cash burn for our operating activities. All measures have been taken in this regards, and we see that in course of the second half of this, we see a stabilization of our operating cash flow, and it's clear that our innovation projects, the ventures, we come to it later, they will need project financing to drive them ahead, while historically we typically have funded innovation projects from operational cash flows. Another focus for the months to come is to restructure our financing or our credit facilities, in the sense that we want to replace the uncommitted facilities by longer-term committed facilities, so that we have more certainty in this regards as well. Our credit facilities have been set up or put in place in 2020, when the focus was on having facilities available for working capital financing in view of a significant sales growth, and therefore they have been uncommitted. And now, with the different circumstances, we are looking and have started discussion with our banks to to change that into committed facilities. However, these discussions have just started, and it will, we will provide update as soon as there are some tangible results achieved. With that, I hand back to Carlo to take us through measures taken and outlook and current situation of the business. And I'm happy to take questions later in the Q&A on the numbers as well.
Thank you very much, Xaver. So I carry on from here, and the first thing that we have done when we have been surprised by the market cliff was to look at how we could reorganize ourselves in what looked to be a quite distressed market. And the key word for us was agility. So in order to have more agility, we decided to create dedicated business units with dedicated business unit CEOs and corresponding P&L responsibility and teams. Focusing on small teams in a difficult market time allows you to have information that goes directly to the front line, from the front line, and we have a very clear mission and target agreement with the smaller business units. Now, this has been executed very nicely. Additionally to having 3 growth units, textiles and flooring, life sciences, and antimicrobials, where our commercialized innovations reside, we have created a venture unit, which I'm overseeing, and we have 4 ventures at different degrees of maturity. We'll talk more about them: Ionic, Garphenix, Ecos, and Baxel. We have also looked in detail on our supporting functions, on the group supports and the localization of them. The focus has been on lean group support functions, and we are looking on having an allocation of the cost of those support functions directly to the commercial businesses and the venture units going forward. Now, if I move into the measures in detail that we have implemented to confront this situation, we have focused, as I mentioned, 3 business units. Textiles and flooring is headed by Mike Abbott out of the USA. Life sciences by Dr. Robin Temmerman out of Belgium, and antimicrobials by Tom Ellefson out of Thailand. And the teams have focused very strongly on mature commercialized innovations to push them further. We have technologies like HEIQ Allergen Tech and HEIQ Min that have been recently launched and performed much better than usual innovation launches. So we see that we're gaining market share back again in a difficult market with our innovation, thanks to our innovations. So it has been essential to maintain our capability to support the innovations and to deliver to customers in this market situation. We've also restructured, and concretely we have relocated. So the relocation has been of more than 20 employees from high cost general headquarters Switzerland to our new service hub headquarter Portugal. And we've done this without losing the capabilities. We have sent into early retirement long served managers and specialists, and we have rehired younger ones in Portugal and have organized over the first half year 2023 the transfer of knowledge and capabilities. We did also a significant switch on the manufacturing side. Since we had invested in the US and expanded last year our investment into our locations in the US, we've been able to transfer more of the operations there, and there's lower energy costs compared to Switzerland. And then from the services overall, we have taken resources from non-essential services and put them into Xaver's team, who is now running finally a 12-team financial team, 12-team strong outfit that can make sure that going forward we are not running into any audit delays. The restructuring in this business unit has been for China. It's one of our key markets. It was a difficult market, COVID restrictions, afterwards lockdowns still. But we feel that the market has much more potential, and old leadership in place was not delivering to the expectations that we had. So we did a replacement, put a more senior manager into HEIQ China, and have aligned an agenda of growth with him. Overall, all these measures that we have done have brought us savings on an annualized SG&A of 15%, and we will see them turn effective into the second half of the year. The first half of the year, as Xaver mentioned, we have still been incurring losses to maintain our innovations going. And the second half of the year, we have stabilized the ship. We're not taking any water anymore. On the ventures, on the financing of the main ventures, we have resorted to a model that we had tried successfully with Hugo Boss to finance directly in the subsidiary. We have done that again this summer with MAS. It's a 3 billion company out of Singapore, and the main supplier for Nike, Lululemon, Patagonia, Victoria's Secret, Odlo, and other performance and athleisure brands. And they have invested into Ionic, specifically 1.5 million. There's another 1 million in the agreement with the milestones in agreement worth 100 million over 5 years. Once the plant is established, that will be negotiated to become binding. Now, if I move into Q4 23, and also how's the focus going forward in the venture units, we are strongly focused on Ionic, which is the most mature one. We have a Series A that we're closing. We are building a 3,000-ton plant in Portugal. The total project invest is 70 million euro, and we are on track to be able to sign off on this next step by the end of this year. We're also, for the other younger ventures, acquiring further grants and also customer paid application developments, which will reduce the cash burn that they're causing the commercialized businesses, so we can maintain them growing, but don't have to, in a difficult market situation, cross-finance it with the profits that we're making on the growth units. In venture, as well as in the growth units, we're strongly focused on strengthening our internal control system so that we can have a better overview in these difficult times of all the processes that the company has implemented. Concerning the growth units, the focus is on cash generation for all of them. All have to be cash flow positive and contributing, and carry the costs of the support units. We have been able successfully to reduce costs for our best-selling products by backwards integration. That's essential. This gives us the ability to gain more market share, or gain more market, or more margin, or both. And this is an excellent work that has been done by our innovation team to optimize. We have also been able, as I mentioned, to win new market share thanks to our innovation, and this makes us very optimistic that when the market recovers in full, we will be able to come out in a stronger position than we were before. We're strongly focused on liquidity management, so also net working capital optimization is essential for us. Several measures that we have implemented, and further ones that we are implementing to manage that. If I go into the support units, then as Xaver mentioned, the short-term financing credit lines are a key topic for us to move them to committed. This is a historical reality that we have had. That's how we have financed over the last 19 years. So it's time to move to committed ones, and that will give us more certainty going forward. The system and process work, as mentioned, is not only on the internal control system, but also on bringing all our companies onto one ERP and CRM system. It's work in progress. We are far advanced, so we're optimistic that in the course of the first half year of 2024, we will be able to close up a lot of these open tasks that we still have in this big project. This will help us and enable to make a timely reporting going forward, so we don't run into the same issue that we have experienced this year. Also, one important point, so we are complementing the expertise in our board with more ESG, because that's really where our venture units are pushing to, with more ESG knowledge and capabilities, as well as internal control system. So let me walk you quickly through the innovation update, and I start with the commercial growth units. What's happening in textiles? The market is still bad. The only winners are the discounters at the moment. The good news is several of these discounters have started using HEIQ technology on large scale. So we have seen this happen and positioned ourselves to take advantage of that situation. We expect that we can grow with the discounters as well as the premium brands when they are coming back. There's still overstocking, but one day it has to end, so we're ready for that. There's difficulty of payment terms. We are working very closely with our customer base to make sure that our net working capital is correct. And thanks to our innovation, we have been successful, and we have more innovation that we are to bring to the market shortly, which we think will have the similar impact than the last couple of ones that we have launched. Floorings remains challenging. The building industry in the US is not on high gear. Simply the interest rates are too high, so mortgage finance hampers the entire industry. Additionally, there's a shift from where we are market leader carpet to tiles, where we are initial. So our team is working to extend our capabilities into tiles too. What I can say we have done successfully is to backwards integrate in the carpet field our technologies. That gives us the opportunity to gain market and or margins. On a nice note, the industrial chemicals, which is a small part of that business unit, is more than doubled. Clear sign for the Biden Build Back Better initiative. The US is reindustrializing. Our strategic investment in the US, our buying land and building there last year, are the correct choice. So we believe that we have a good opportunity to take advantage with our offering of the global market growth in the United States. Life sciences, on a sad note, we decided to divest from the medical mask business. This has been very profitable during the pandemic. The market has now almost subsided, so it's not worth for us to push it further. So we will look at our operations in Spain, and we will how we can restructure that, and we will definitely reduce our presence in the medical mask field. On a good note, HEIQ SynBio, which we acquired a little bit more than 2 years back, has been very successful. We have established it as a technology for probiotic cleaners for hospitals. It's anchored now in the industry, and it's also anchored in the new European detergent regulation. So we do have managed to reach, took a bit longer than expected. Also, the Lancet article got published in the end. We have expected this switch of the industry from disinfectants to probiotic cleaners, and it's now happening. So we have big expectations for 2024 to see a real switch in the market, which gives this business unit the scenario for a strong growth. We have also successfully integrated a new production facility in view of this market growth. We have invested in into our capacity. So we have an automatic manufacturing plant that can serve the volumes that we expect to come. And we build it with a cosmetic grade, which has just been audited with ISO 9001. So we are able to serve not only the healthcare cleaners industry, but we can also start serving the higher margin industry of cosmetic brands, where we can be an OEM for them in 2024. Our smallest commercial business unit, antimicrobials, is in the same situation. FMCG brands have suffered from lower consumer demand due to high interest rates and to inflation, and the discounters are growing also in this market field. There is overstocking, and also here payment terms are difficult. Also here, innovation is our way out. It has been our way out. I'm happy to tell you that we have successfully launched HEIQ Chill as an innovation, cooling technology going into master batchers, into polymer pellets, and we are at the moment working with the first. They just adopted for their kit lines, so this is a big success of Team China, that Team Antimicrobials, that have been able to take not the Nike, but the Chinese Nike for this technology platform into our customer range. I move quickly into the ventures, and we start with Ionic, the most advanced one. Here we are making world's first climate positive cellulose filament fiber. The mission of this technology is to replace polyester. We are in an industrialization stage, and we are in the raising of a Series A in the subsidiary for the next 18 to 24 months. Well, here we are with the product on market in terms of time to market. Hugo Boss is selling it, and we're sold out with the small pilot plant that we have in Austria. So we need to rapidly scale to maintain the momentum and stay in the limelight of being the most sustainable textile technology around. The price is very big here. We are the only fiber that can replace polyester, and that's a 135 billion market. So the team is working very hard and it's growing. We're financing this team directly with our customers, investing into the subsidiary in order to give it the momentum to reach scale and also later on price parity with polyester. Younger technology, but also on the market, HEIQ Ecos is our silver nanowire technology for low emissivity coatings. That's a transparent, conductive, heat-reflecting coating, which can also be used for stealth effects. Here we are on the market. We're working on application developments with customers in defense, in greenhouse, and in window sector. We hope to conclude agreements with them very soon, some this quarter and the next ones in 2024. So we're on the market with small quantities, and the USP here is that if applied in households or in greenhouses, we can reduce the energy costs by 30% or improve the efficiencies by 30%. I moved to Graphenix, which is more initial, so it's 2 years from market. Here we have a highly porous graphene membrane, which we have decided to use in solid-state batteries and electronic vents. We have a pilot plant. Now we're building a pilot commercialization plant, so it's the next scale-up step. Mid next year, that machine will arrive. We are about to sign a JDA with an industry partner for the first application, and also this will mean that this technology platform will start to self-finance, so we don't need to do the cross-financing. The opportunity is also very interesting. We are, with our membrane, enabling what is called a solid-state battery made out of plain lithium. It has a double charge and 10 times faster recharge or discharge at a fraction of the weight. So it's really the solution that everybody who's driving an electric vehicle or has a mobile phone would like to have as his next battery. And the youngest is a backwards integration, HEIQ back cell. We're using agricultural waste to feed bacteria and create a bacterial cellulose, which is a superior feedstock. We do this by precision fermentation. This is the raw material we need for Ionic in an ideal world, but it's also a raw material that we can use in packaging, in medical, in cosmetic, and in the food industry. So a wide use of market potential. In our primary mission is to make it work for our Ionic fiber. We are in a pilot plant scale-up stage right now. We have delivered proof of concepts on a static industrial reactor. Now we're moving to a dynamic industrial reactor with 10-fold capacity and yield. And we will then move this technology one step closer to industrialization. Here are the USPs that we can take abundantly available circular waste from the agricultural industry to make a superior cellulose that can enable us to spin the super strong fibers or strengthen packaging materials significantly. So I moved to my last slide with the restructuring into smaller units. We're closer to the market, closer to the customer. We're closer to the problem that we can solve with our technologies. We have the pulse of the markets. Our teams are organized more narrowly. They have been empowered to make decisions at the front line. So we are confident that with this change, we are more agile and we maintain our capability to deliver to the market. And what we want to deliver to the market is technologies that improve the life of billions of people by using material innovation to make everyday's products perform better or more sustainably or be more circular. So I close with investing in HEIQ means investing in impact. And I'm happy to move now to the Q&A.
That's great, Carlo, Zaba. Thank you very much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a couple of moments to review your questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Carlo, Zaba, if I could ask you please to open up the Q&A tab, as you'll see you've had a number of questions from investors throughout today's presentation. If I could ask you just to read out those questions and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Yes, okay. We'll do so. First question is, what is the current situation regarding the exclusive agreement complaint against ICP that we have filed approximately a year ago? Carlo, can you give there a short update?
Yeah, so our position is unchanged. Actually, is stronger than ever before. We are very clear in our position that ICP has commercialized and launched and sold the product to market. Their end customer was actually the National Health Service of the UK. So the contract has to be lived, and our claim stands. So we are, of course, we're in litigation with them. We are always open to sit on a table and discuss settlement terms with them, but we are proceeding according to the US legal procedures to carry the claim forward.
Thank you. Then there is one question. You mentioned that there have been no further drawings on the facility, but how much has cash been reduced since June 30? So I answered that myself directly. As of June 30, we had 7.3 million of cash as per the published balance sheet. Since then, this cash balance has been fluctuating between 6.5 - 7 million. So that's so we see a clear stabilization of the cash situation there. Carlo, a question for you. With Renew sale dropping by over 85% after admitting to reduced demand. Can you please provide an update on Ionic as it relates to what trends you are seeing in the sustainable fashion industry?
Sure. So this is very unfortunate for RenewCell and its brilliant CEO that this has occurred. The situation that they have been confronting. RenewCell is one of our suppliers, so we can use the circulose that they make from waste textiles to spin our Ionic fibers. And one of the big difficulties that they have been facing lately is that the cotton price, because the textile market is diminished, so there's less demand. Obviously, the cotton price has come back significantly. Now, what they are doing is circular cotton, basically. So cotton waste, and then they recycle that and make it available again. And if the virgin one costs less than the recycled, then the people in the brands that have bonuses based on their profitability will not make the choice for the more expensive solution that is on the market. This means that offtake is essential in order to make scale of sustainable technology. It has to be binding offtakes. The brands need to commit with their CEOs that they're willing to accept higher prices if the markets are fluctuating, and only then a technology can go to scale and be successful. Otherwise, we're going to be sitting on polyester in 50 years, and literally on the beach, we're going to sit on it and not sit on the sand anymore. So here, a clear case for offtake agreements, which is one of our imperative tasks for Ionic in order to securitize our investment and scale with confidence.
Thank you. Then if we stay with Ionic, there's another question. What is the implied equity valuation for Ionic in the Series A? So that's the upcoming round. And what is HEIQ's equity stake post-dilution? So to what level are we willing to get diluted?
So we made two valuations. At first, the implied valuation with Hugo Boss when they invested was 200 million for the technology. With MAS, we pre-negotiated a binding offtake agreement, which is a big engagement from their side and shows the leadership they are putting to the plate to make sustainable garments. This has then resulted in a combination deal where we have reduced the investment to valuation, implied valuation of 100 million for the Ionic technology platforms, together with the offtake agreement. The dilution that we're willing to take in Series A is maximum up to 25%, and this is what we are at the moment looking at and executing.
Thank you. Then two questions that go in the same direction. First question, does HEIQ have any asset it can monetize to avoid an equity raise? And then the second question is basically, considering the current debt position, should investors expect a right issue or an equity raise in the upcoming?
So I think we can answer that by saying there's always a plan A, a plan B, and a plan C. Yes, we do have capability to sell assets, but obviously the market conditions to do that are not enabling a value capturing. So the board and the management are not looking with priority to this as an event. If I take the second question, are we foreseeing to make a raise on the topco? No, at the moment we are not foreseeing to raise that. As mentioned, our strategy is to, and we have done that, to stabilize the cash flows on the commercial businesses and to finance the venture businesses directly.
Thank you. Then the next question is, what measures are in place to keep investors informed and guided in the future?
Yeah, it has been very unfortunate that during suspension and audit, we couldn't really talk with our investors in detail. So we are certainly making sure that that is not going to happen again. And we have also strengthened our finance team around Xaver, so that we are now much better prepared to have this interaction on a more regular basis with our investors.
Then there is a question I can answer. You had a significant impairment loss in 2022. Do you expect an impairment in 23? You have mentioned that acquired companies have not achieved their targets. I assume 2023 it's also a difficult year for them too. So we have significantly impaired the goodwills. The one goodwill position that we have not impaired is related to the acquisition in the US in 2017, which since then has always been profitable and has not been at risk, and we for sure do not see a risk of impairment also for 2023. And the goodwill related to life and acquisition is fully impaired, as disclosed in the notes to our financials. And the remaining goodwill position for Crisal and RAS, which is in total about 5 million, there we don't see an immediate further risk for impairment as of today. Then we have another question. When was Anta deal signed? When did it go live? I think
I'll take that. So it was just decided recently that our technology got adopted, and it's already being live in production operation. We're not announcing it because we don't have a contract in this sense, so we will have to see how big the program will become. It's their first division, the children division. If we are able to flip it into their footwear, then that's the big market for us there. But it's good work by the team to get into Anta in China, very competitive market, and we have been able to do that.
Then there's a question: where do Ionic shares and value reflect in HEIQ's balance? HEIQ Ionic, the project, the subsidiary that's as of today, HEIQ owns 96% of the subsidiary in Austria. So this is fully consolidated. Therefore, assets and the liabilities of it are included in our balance sheet, which is mainly fixed assets, and the income and costs as of today, due to the scaling of it, it's rather costs than income that's included in our profit and loss statement.
Okay, then I think we are to the last question. 3 acquisitions that we made and partially paid in shares. If we had to compensate the recipients since, no, we did not. The terms are the terms that we have disclosed, and we have acted according to them. And then I take a last question that just came in. What's the cost of Ionic today on sale? Where will it be compared to polyester? So I make a historic reference. When polyester went to market 40 years ago, or a little bit more, the price was equivalent to $38 a kilogram in the start today. And if we take Ionic, then we are around 35 kilogram today from our small pilot plant in Austria. And if we foresee with our modeling where the price is going to go, polyester is today at 160, and in 2030, if we scale as per plan, we will reach $2. So we will reach the price parity in the medium future. So that's then also the basis on why we are very positive on this technology being able to be a real substitution candidate for the synthetic fibers in the textile industry.
That's great. Carlo, Xavier, you have addressed all the questions from investors. So thank you once again to everybody for their engagement this afternoon and for your time in being so diligent in giving those answers. Carlo, if I may, I know investor feedback is important to you, and I'll shortly redirect those on the call to give you their thoughts and expectations. But I wonder, before doing so, Carlo, if I could just ask you for a couple of closing comments just to wrap up with, and then I'll send investors to give you their feedback.
It has been a very challenging time for our team to play offense and defense in a disrupted market. So it has been something to point out that we've been able to maintain our capabilities and serve our customers, stay close to them, keep innovating. And I strongly believe that we're going to be through the storm, if not now, in the very near future from a market perspective, and that HEIQ is very well positioned to return into its market share or market growth, and thanks to its innovation to actually exceed its position and take advantage of some of our peers and competitors that have divested more strongly in their services, and we will be able to trump out on that.
That's great. Carlo, Xavier, thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. It's only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of HEIQ PLC, I'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you, everybody.